Hello, this is Greg Giardino,
And I'm Alison Hall.
and we're here with you today on It's Your Smarter Money. And the theme of today's video is New Year, New You. How do we start the year of 2025 off to a really strong financial start? So I'm going to swing things over to Allison, and she'll talk a little bit more on some key areas to focus on here in 2025.
Well, most people regularly check their account balances and portfolio performance. Tracking net worth instead is going to give you a more comprehensive view of your situation. If you recall, the equation for net worth is assets minus liabilities. So it's also taking into account any kind of debt that you have, which is a much truer indicator of your overall financial health and progress. A growing positive net worth usually means you're heading in the right direction. For those of you watching who are active clients, your client portal does allow you to track and compare your net worth year over year. To do so, you're going to log into the portal, click on the Reports tab across the top navigation bar, and then select Net Worth History from the Report Selection dropdown, and it's about 3/4 of the way down. In addition to paying down consumer debt, which is usually goal number one as far as improving your net worth, the other factor that you have a lot of control over is saving. So what percent of your income is being saved for retirement? Every household's different, every retirement goal is different, but generally speaking, those that are successful are contributing between 10 and 20% of gross income to savings. Depending on what your cash flow can handle, you may not be able to hit this 10 to 20% target, but it's important to just have a goal and put steps in motion to achieve that goal sooner rather than later. It also definitely helps to automate things. Your employer-sponsored retirement savings are deducted directly from your paycheck. Do the same thing with your non-employer-sponsored savings. Either add a secondary account so that part of your check goes to your savings account instead of your checking. This way you never, see it, you can't spend it. Or, treat it like a bill pay item. So you set up an automatic transfer from your checking to your savings and just know, well, on say the 5th of every month, I have X dollars coming out, and kind of ensures that you pay yourself first. If after a few months you find that your cash flow can't support the savings goal that you've set, you can revisit. And that's going to lead us to what I'm sure is your next question, which is, how do I know what kind of savings my cash flow can support and what needs to be adjusted so that I can actively grow my net worth? And Greg's going to help us out with that.
Thank you, Allison. So another key metric is cash flow. So what is that? That's money coming in and that's money coming out. So we recommend you really treat your cash flow as you would a business. It's super important that you know your various income sources and where that money is going. So let's talk a little bit about income here. Do you anticipate in 2025 having a higher income year? If so, generally speaking, you may want to defer compensation and you may want to save more into pre-tax retirement plans like 401ks, 403bs, and 457 plans. If you anticipate a lower income in 2025, you're in the lower federal marginal tax brackets like 10, 12, 22, and 24%, usually you may want to accelerate income. So what does that mean? Maybe you want to start tapping some of your IRAs if you could do so penalty-free, because they're usually taxed at the highest ordinary income tax rates. Maybe you want to look at taking your IRAs that are pre-tax and maybe transferring it over to a Roth IRA. You never want a low tax bracket year to go to waste. And also, maybe if you have accounts that are outside your retirement plans in like a brokerage account, and you have positions that have really high unrealized gains, well, maybe it could make sense to realize them and sell them this year. So these are all things you should be keeping account of and keeping in mind for 2025. Now, will you be getting a bonus in 2025? If so, make sure you determine ahead of time how much you want to save of it. A lot of our clients, if they're really trying to gear up towards retirement, maybe you want to save 100%. Make sure you take the time to adjust your withholding before the bonus gets paid out, just to make sure that you're saving 100%. Also, if you get your bonus in December, perhaps there's a way your employer can push it out until January if you think the following year will be even lower. These are some things to think about. Now, we can't talk about cash flow without talking about your expenses. So you don't have to look at this every day. You don't have to look at this every month, but we advise our clients to at least look at it once or twice a year. So if you don't know what you spend per month, look at the last couple months of last year, maybe take a 3-month average. This way you could figure out what your monthly spend is. And if you have not set up a budget yet, now's the time. So most folks, you may not know this, but the Mint budgeting app is no more. Allison and I, we do not work for Monarch Money, but that is a popular tool a lot of our clients like. The fee's nominal, and it's maybe under $10 a month, and you can get a free trial. So we'd say look at Monarch Money, or You Need a Budget, also known as YNAB. Those are some pretty good apps to help you set that up. And then finally, when you look at your expenses and you finally take a look at what's under the hood, see if there's anything that's abnormally high. So we often find that housing expenses make up a large percentage of expenses. A general rule of thumb, you don't want to spend more than 20 to 30% of your gross income on your housing expenses. If you go over 36%, usually it compromises your other goals. Also, we find that a lot of clients, they do not account for their housing maintenance expenses. So this is an underlooked area. Another general rule of thumb, you want to allocate at least 1 to 4% of the purchase price of the home in a budget for housing expenses. So for example, if you have a house in Florida that's $700,000 fair market value, it's fairly new, it doesn't have a lot of wear and tear on the home, maybe you want to take 1% of 700,000, which is $7,000 a year, and allocate that towards your budget. And of course, if the house is older and has a lot of wear and tear, well, maybe you want to be closer to 3 or 4%. So keeping all these in mind, we hope these tips get you off to a much better start here in 2025. And until next time, we'll see you soon. Take care.